The main headwind for gold at present are higher interest rates, but it can be counterbalanced from high risk and high inflation.
We've ended a period of global, unprecedented global monetary and fiscal easing, and we're reversing that.
Due to these headwinds and downturn equity space, I think you'll see this transition to, the royalty streaming companies.
The potential acquirers they don't want to take risk either. They're all pretty scared. They don't want to try to build a mine. They don't want to try to permit a mine. They want to just, they want an easy life, I think.
Just welcome you and thank you for being here today, and thank you to the 121 Mining Conference for having me here today. I host a global radio show and media outreach for the mining sector. We have a global audience of about 7 million people that are really interested in mining. I will ask Chris Mancini, Portfolio Manager with Gabelli Funds, to have a seat here. I will invite James Steele to have a seat, along with Stuart McIver, his Managing Partner with Amvest Capital. James is the analyst for precious metals for HSBC, a global bank. We're also going to hear from Juan Carlos Artigas. He's the global head of research for the World Gold Council. And I will take a seat with these gentlemen, and we will start, and hopefully Chris will join us at some point. I think on your program, everybody, there's a question about, and you don't have to look, about Russia's impact with regard to the Russia-Ukraine war on precious metals and the possible knock on mining equities. Can we blame this at all on Putin, the downturn in the market, gentlemen? I'll start with you, Juan Carlos.
Well, I mean, I'll address the impact of geopolitics. I think it is on, right? Yeah. Can you guys hear me? Yeah. Okay, cool. I would maybe take it a level up and say that the impact on geopolitics, in particular in gold, is considerable and it's important. And it's one of the reasons why, to a degree, gold has performed well this year. Actually, it's one of the best performing asset classes so far, in spite of the underperformance over the past few weeks. And part of the reason is, well, gold has been negatively impacted by higher interest rates, but at the same time, risk remains high in investors' minds. And a contribution of that comes from geopolitics, and very much in particular, the war in Ukraine. Now, that's, certainly on the demand side, and the fact that we had significant demand, both from the perspective of gold-backed ETFs, as well as physical, gold, bars, coins, and so on and so forth, especially at the beginning of the conflict. But, interestingly enough, I think that it has also made apparent that gold is one of the few assets that does react as a safe haven in periods of stress, right? And the war in Ukraine was, again, a very recent.
You said do not act as a safe haven.
Gold does act as a safe haven. Okay. And again, it was an example of these that, can be quite recent.
Why isn't that safe haven aspect of gold? And, I agree. If you look at gold over the last 20 years, you're probably seeing a 700% increase in the price of it. It seems very safe. And perhaps when gold hit $2,000 an ounce, that was a little bit of a bubble, of a pop that was not sustainable. But if you're in the equity space and you're dealing in the commodities and the stocks, maybe you're not feeling that way. So maybe the win really isn't precious metals and collecting actual physical gold or ETFs in some form. And I want your response to that question, Juan Carlos. And I also want to ask James, as a banker, how he views the commodity.
Well, I mean, in particular, if you're asking me, whether investors are going to feel differently from owning gold versus owning mining equities. I mean, just full disclosure, our focus is really on gold as a physical asset. So my expertise is not so much on the mining side, and I may not be able to add as much. Maybe Stuart can comment, or as you said, James, what I can tell you is that investors do use both gold and gold mining equities as means to express a view on gold, oftentimes in complementary ways. Because when especially when you have an equity rally, mining equities may also benefit from that, right? And that's why many asset managers try to capture that from the mining equity side while still keeping exposure to physical gold, especially to protect it against the downside in the market.
So, and I don't know, that's why I'm asking this question, Juan Carlos. Gold can be used as collateral now in many business dealings. And is it safer to use as collateral than, let's say, cash? Not safer than real estate, but is it used in that arena, do you find?
Collateral? Absolutely. Actually, one of the, gold is one of the few assets that is extremely well regarded in periods of significant liquidity crisis. Even if we dial back the clock to early pandemic days in March of 2020, when the credit crunch, the mini credit crunch happened, and all spreads were blowing up, bid-ask spreads were blowing up for, all sorts of assets, including long-term treasuries. Gold bid-ask spreads remain quite steady. And it is in part because, again, gold is no one's liability. It's an asset, and it's really, it's a very liquid asset. Just to give you a perspective, gold trades on a daily basis north of $130 billion. Which is comparable to the collective liquidity that you find in short-term treasuries, right? So it's an extremely liquid market. It's no one's liability. So if you have something like that, you can definitely use it as collateral, and therefore, it tends to behave well and not be under stress, even in periods of significant pressure on the market.
Thank you. James, you are an analyst for a very large global bank, HSBC. And I'm wondering, in times like these, do you increase your exposure to gold? And how do you look at it as a bank as far as protecting your assets, which for the most part, I assume are related to currency? So give us a bit of an education if you won't mind, especially me. I need one.
Surely. Well, HSBC, just to sort of give it some flavor and carrying on from what we were chatting about outside, I think HSBC is commonly regarded as the world's largest bullion bank. And HSBC as a bank specializes in international trade. And so the two are quite closely linked. The offices that I work in are at 452 Fifth Avenue. Right next to the New York Public Library. And I'm always able to pinpoint where that is for clients or anyone who's asking me, because I simply ask them if they've seen Ghostbusters. And the beginning is when they charge up the public library, and I say, we're the building right next to that. But in that building, 2 floors below, the street level, and I'm not giving away anything that is not public knowledge, is the gold vault. And it's a precious metals vault, and it's a working vault. We'll get precious metals to anyone in 2 days. It's the largest bullion vault in the American continent after Fort Knox, and is conservatively several times bigger than the one at the Fed at the bottom of the island. And we have a sort of soup to nuts approach to bullion. Our clients go from mining companies to recyclers and fabricators, through to jewelers, through to mints, central banks, portfolio managers, and we're custodians for the majority of the world's precious metals ETFs. So, we view the market on a very broad basis, and what we'll often find is that parts of the gold market are hot and other parts are not. The jewelry market might be coins and bars, might be interesting, so we'll work a lot with mints and maybe less so with the investment community, and then another year it'll be different. And we are as far as gold goes, as far as HSBC is concerned, we're sort of agnostic. But my job is to sort of point to where I think the price direction would be. And just echoing from what Juan Carlos said, safe haven is the key. When I speak to people about gold, there's sort of two ways you can look at it. And one is, do you think the price will go up? Do you think the price will go down? And within what time frame and what volatility? And therefore, I'm going to buy or I'm going to sell. That's one aspect of it. The other aspect is the safe haven aspect and the insurance. I mean, I don't want my house to burn down, but I have fire insurance. And the safe haven aspect of it is the one with the real longevity. And, it's been seen, and the World Gold Council have produced studies along this to show the ability of a portfolio to be hedged with gold. And that tends to be what I would speak to a lot of our clients about.
So are you making any predictions henceforth with regard to the price of gold in the future? That would seem dangerous, but I guess both of you gentlemen can do that if you wanted to based on the statistics you've compiled.
Well, I know that I'm going to say Juan Carlos having to say, but I don't think you can, right?
Well, I have something potentially slightly better for investors, but after you, Jim.
We have published figures. We have an average price of $18.20 per ounce, $1,820 per ounce this year. We're predicating that, in a nutshell, we're predicating that on higher interest rates. And basically, we're at the beginning, we've ended a period of unprecedented global monetary and fiscal easing. And we're reversing that. Governments' debt to GDP ratios are going to fall, and interest rates are going to rise. And that are two significant headwinds to the gold market rallying. So that's the major negatives. The major positives are geopolitics, which Juan Carlos had discussed. And that, I think, is going to keep gold at a higher level than we would normally have seen. Also, we have extraordinarily good retail in inflation related buying of coins and small bars. And that's the man on the street. Interestingly enough, we did not see the portfolio, the professional portfolio investment in gold until more recently. $1,820 per ounce is our average, and that's public knowledge.
And when I was saying that, so as Jim said, we don't forecast the price of gold because we are a not-for-profit organization that was founded, and it's funded by major mining companies. So we don't forecast the price of gold. However, what we've done is build a valuation model and a tool that lives on our website where you can actually look at different macroeconomic scenarios or build your own scenario. And we've done a lot of analysis to help explain how those macroeconomic variables like economic growth or risk or inflation and so on and so forth influence demand. And from that perspective, in terms of market equilibrium, investors can see based on their own assumptions how gold may behave in different conditions. But roughly speaking, I would agree with Jim that the two, the main headwind for gold at present are higher interest rates, but it can be counterbalanced from high risk and high inflation.
Thank you. I'll circle back with you in a few minutes on that. Chris Mancini joins us. He's a portfolio manager with Gabelli Funds. Chris, welcome. Moving on to Stuart McIver for the next question. You with Amvest Capital have a relationship with many companies with regard to financing in the junior and occasionally the mid-tier space. Word on the proverbial street from my end, and I've been focused on in the junior space for many years, and it's more of a panic space, I think, than what we've been discussing in the last 10 or 15 minutes or so. How is that interest in financing? How's the dynamic changed in the last year or so with getting these juniors real money without having to give up a lot of dilution in their stock?
Well, I think so. From like March 2020, the gold equities market in the junior space was a lot stronger. A lot of these companies found it a lot easier to raise money, and these Canadian, Aussie companies had much larger exploration budgets. Enabled some, good discoveries. De Grey in Australia had a massive gold discovery, so that kind of put confidence into other equity investors, retail as well. But, you know, due to these headwinds and downturn equity space, I think you'll see this transition to, you know, the royalty streaming companies. There's been more companies, probably 10 more royalty streaming companies in Canada added in the last couple of years than there were before. And the kind of hybrid, you know, non-traditional, you know, project finance groups.
And I would assume companies that are involved in that are in near production or about to produce, and therefore maybe scratch that for a second. Companies that are near takeout, they're near an M&A and possibly near production. They would be that risk would be the investment risk would be mitigated by that fact, which doesn't leave a lot of hope for these greenfield or early stage production companies in the precious metal space, does it? At this time,
no, yeah. And then you've seen some of the companies, some are trying to get in production at the moment. You would have heard of that have, you know, hit some issues processing wise, or hadn't done enough exploration, have too much debt, and you know they're gonna have to find some, you know, non-traditional forms of financing to, you know, get them out of that pickle.
And Chris, as a portfolio manager, you know, how's your risk appetite changed over the last couple of years?
Yeah, thanks. Sorry, I'm late. I think that we've gotten, you know, we've been focusing a lot more on the free cash flow generative companies. I mean, one thing that's really interesting is that you can, you know, a few years ago, you'd have a development stage company trading at 0.8 times NAV. Now you have production companies, you know, Yamana, before it was bid for by Goldfields, was trading at 0.75 times NAV. That's a company that produces close to 1 million ounces of gold a year, generates a lot of free cash flow, pays a dividend. So it's just hard to decide to really go way far down that risk profile chain when you have companies that are less risky, that are trading at valuations that they were trading, that like much riskier companies were trading at just a couple of years ago. And the other thing is that the market, that like the acquirers, the potential acquirers, they don't want to take risk either. They're all pretty scared. They don't want to try to build a mine. They don't want to try to permit a mine. They want to just, you know, they want an easy life, I think, like the rest of us do. And for them, they've realized the easiest thing to do, I think, is to buy something that's in production. So we've seen, you know, even the really disappointing deal that Goldfields did to buy Yamana, they still chose to go down that route, even though their stock was really punished. So, you know, from our perspective, we've been kind of going where the market has been taking us, and that's into cash flow generative companies.
So here's what I'm hearing on this end of the panel here is we're going to see a real problem with supply in the coming years, because as far as I'm guessing, early stage development, greenfield development is just not going to happen right now. And that should be a driver for price down the road without making any predictions. That in a sense could set off a bull market, because the demand for physical gold is not dissipated. It's increased, if anything. Your thoughts?
Yeah, look, I mean, definitely gold's scarcity is one of the contributors to long-term performance, right? So the fact that gold is scarce is definitely one of the reasons why gold has increased over time since times immemorial, right? I mean, it's something that people look for, and it's not something that you can get everywhere. It is interesting and it is important to understand, though, that from a supply perspective, you have two sources of supply: mine production and also recycling. So recycling makes up anywhere between, you know, call it 20 to 40%, depending on the period of annual supply, right? Which basically tells you that, again, you know, for the market to come to balance, right? To reach its balance, people need to be willing to sell, because mine production generally does not meet demand. So as you said, demand, is not dissipated. Demand is strong, and mine production by itself is not enough to fulfill demand. So therefore, the remaining needs to come from people willing to sell, whether it is their jewelry or transact, in bars and coins and so on and so forth. And again, that explains the reason why gold prices, if you dial back the clock to 1971, have increased on average 10% per year, right? So yes, I mean, I think that what is interesting as well, though, is that mine production, fluctuates a bit, but it's still relatively stable. So, even if you don't see a ton of production come in, and there are, of course, people very knowledgeable on the other side of the panel talking about potential exploration. But overall, if you look at a longer period of time, the reality is that the bulk of gold available for transactions is already above ground, and mine production is just increasing marginally that amount, right? And that's one of the reasons why gold really stands out relative to pretty much any other commodity.
I would just echo that we have, and a lot of it's WGC data, but also the United States Geological Service. I mean, we have significant amounts of above ground gold. It is never consumed, unlike oil and wheat. It is somewhere. Now, we did and this was not scientific at all. This is just a straw sort of poll. But we found that most people have twice as much gold and silver in their house as they think they have. If you ask them, do you have an ounce? Well, I have an ounce. And by the time they actually went through and looked for everything, they had a couple of ounces. And like Juan Carlos said, I mean, at certain prices, the gold market, this does get mobilized. And it also comes off when price is too low. And if you just try to monitor the recycling market, and that's one of the reasons that the market had a tough time over 2000, is because we immediately see an increase in recycling and fabrication, and that gold comes onto the market in 30 to 90 days. And again, when it drops too much, as we saw earlier, in the decade, the recycling comes off very quick. It's very price sensitive, whereas mining is not price sensitive.
I think that's all very true, but I mean, I do think that mine supply will be declining, like you say, and I do think that, well, I mean, I'm not an expert. These two guys are the experts on the supply and demand side, but it does seem like given that that there is a lack of capital in the sector and an unwillingness of the big guys to acquire and grow, if the mine supply, because mine supply has been increasing over the past few years, and if it does eventually peak, or I think is it peak now? Is it?
I would say maybe next year or the year after. What would you say?
Yeah, I mean, it continues to increase, but again, and again, I'm not disagreeing with you. Definitely, the scarcity of gold contributes to price, right? I mean, absolutely. It is an important component. In fact, actually, our valuation methodology is based, in fact, of that market equilibrium, right? You do have that, and it contributes. It's just that it's slightly different, in part because of how, as Jim was saying, to a degree, mine production is a little bit less sensitive to price. I mean, because shutting down or starting a mine is not something that happens, very often. But yeah, I mean, in fact, actually earlier in this millennium, which is kind of funny to call it that, but it's true, at the beginning of the 2000s, there was a decline in mine production, right? And that also, contributed to a degree with the increase in price, especially if you combine it. But again, I'm just saying, kind of like longer term, when you look at it, it is a contributor. You just need to remember that it's not the sole contributor compared to something like oil or something else.
Yeah, for sure. For sure.
Production is the only thing that matters.
Yeah, for sure. So anyway, so we agree.
And even I think, there's a psychological element to it, which is supportive. Not everybody knows there's a lot of gold above ground, and a lot of it is not mobilized quickly. Some of it is, but much of it is not. A lot of it's in central banks, or elsewhere. If you pick up the Financial Times and it says that XYZ, mining companies are not replacing reserves, Even though there's a mountain of it around, that's still supportive. 100%.
Tailwind at least. Yeah.
You're going to read that. You're still going to think.
Yeah, sure.
So I think what we're going to see, and James, you can verify this or not, is the crunch for new projects that aren't being financed and slowing down the supply of physical gold underneath the ground. That may come to not an end, but definitely a further crunch after a while, with a lack of new exploration, especially for low grade projects. That will naturally change the M&A picture with regard to these projects that aren't getting financed, or perhaps can get acquired by mining companies that have had some success and have been financed, making it more attractive for some of these mid-tier and major companies to come in and just grab up these projects that can't get financed otherwise.
Well, I mean, broadly, I think so, but I'm going to defer to my friends.
I meant that question for Stuart. I apologize, James.
Thank God. You said James Stewart. Panicking only because
I get confused.
I'm not allowed to speak on
I meant that for you, Stuart.
No worries.
Sure.
No, you've definitely seen some projects that have been around and only kind of in the last 2 years have been able to get, I'd say, lazy equity money from, Canadian, Australian retail. But now with like cost pressures increasing at the mine sites, these projects again becoming marginal. Like Western Australia, for example, only until March could they get new mine workers in. So the mine wage inflation was going crazy in Western Australia. So it'd be interesting to see how those kind of marginal projects, that were top of mind for some people last year, going forward, I don't think will be.
Well, how are we going to create new value in this space? We agree that physical metal is in a good place, even though the price of gold has dropped another $10 today. We're still safe in the $1,800 an ounce range. How are we going to? This is a mining conference out here. There are, 80 companies that are hoping for your money. Where do you, in a really tough sector, and there's good stories out here. I don't want to take that away from anybody. There's really good stories here, and there's real opportunity to go long and not be a trader. Traders are pretty much unwelcome, I think, in this space right now. Where's the real value here? How do you get involved? Where's a good place to put money right now if you're here attending this conference and you're not so hot on equities but hot on gold? I know I'm being a little bit confusing right now because I am confused. Well, I think everybody is.
I think it's been good to see like kind of the crash in cryptos a few weeks ago, and the ease of some financial products to get investors into the gold sector. Like US equities, you're seeing more people trade themselves instead of outsourcing to wealth management. There's apps like Robinhood, you can buy stocks easier. But even in the gold space, like the Perth Mint, I know did an IPO for the first redeemable gold ETF. So if you had $500 of gold, you could redeem it. They send you a little coin in the mail. You have $1 million of gold and they send you a Brinks truck to your house if you want to redeem it. But having kind of financial products like that, I think bring more people into the space, ease of buying the product as well.
I think one place to go, I mean, in terms of investing in companies here, I think that you need to find companies that have economic projects where today, if there were capital available in the sector, someone investing in the project or through buying shares in the company would get a high IRR given the spot gold price. And we were just talking today I was talking in a group amongst ourselves. And one concept that I think it wasn't my idea, it was actually a mining company CEO's idea, but have the concept of if the market's not going to finance it, and if a production company doesn't want to buy the stock outright, maybe enter into an agreement whereby the junior who's found the gold and has a economic deposit has a major take a stake, like essentially fund the development of the project in exchange for a percentage stake in the project. So not the company. So meaning that at the end of the day, the junior now who has 100% will end up having 40%, but doesn't have to put up any capital, and the market doesn't have to put up any capital, because the free cash flow generative company, which is generating a lot of free cash flow, is willing to fund its fund it into production.
So, Chris, in general, how do you feel about opportunities right now in the market? Are you happy? Are you feeling great about partaking in some of these companies out there? You don't have to get specific unless you want to. I guess I'm not asking you to do that. But these are potentially good times ahead of a real bull run in the market. Does everybody feel that?
If it's hard to say what the price of gold's going to do. As we know from James and Juan, but I think that if the price of gold does go up, there's a lot of opportunity out there for gold stocks, and so. But
are you going to make that investment now? Or are you going to jump in now? Or are you going to wait?
These, I mean, I think there are some where, for example, like one that we own and that we'd consider buying more of is called Moneta Gold, and they have a project in Timmins, which it's 100 kilometers east of Timmins. We just met with the CEO today, and the concept there is that Newmont is big in Timmins through their acquisition of Goldcorp, and Newmont produces 6 million ounces of gold a year, as we know. This project could produce, say, between 300, 400,000 ounces of gold per year. And it's, I think I might have mentioned in one of my other comments just now about risk, about CEOs really don't, and managers don't want to take a lot of risk. And so when you buy something in Timmins, where it's a mining camp that's been around for over 100 years, there are lots of miners who live in town. They'd love to be able to drive to the project every day. You're decreasing the risk that you're taking in developing this project. So it's something where Newmont should own at the end of the day if Moneta can kind of prove up what they have right now in a preliminary phase.
I'm familiar with a couple of funds that deal in precious metals, gentlemen, on this side of the panel, that will take a risk in early stage exploration if all the fundamentals are there, especially management. Are you seeing more at the same? Are you seeing more at the same time of a risk appetite increasing, especially in places like I'm just going to jump in and say maybe Africa, where there's lots and lots of gold, or Latin America, for instance. Are you seeing a willingness for? And I guess I'm still talking about gold underneath the ground, because that's what is necessary to produce the gold that's above ground, and Are we seeing some movement in that space as well, or are you strictly thinking about existing physical gold?
Well, I've been saying, just the change in geopolitical risk across different countries. There's been quite a number of transactions in Bolivia of late. A number of silver transactions have gone down there. Foreign investments gone to that country. The election in Peru has put in question marks on some people's minds about what they might do with future royalties or whatnot. And then in terms of the funds that are going in, it can depend on their liquidity profile, and if they're part of a large conglomerate fund that has liquidity restrictions because most of their money is in bonds, then it's tough to get that money into the kind of smaller equity sector because it is a lot less liquid.
I asked Juan Carlos a question before this session here outside, and it's my belief as a journalist and an investor that at the end of all this, the Phoenix will be digital currency being backed by gold. And Juan Carlos mentioned to me that would just be like a candy wrapper. Would you mind elaborating on that, please?
Well, I mean, it didn't use exactly the word candy wrapper, but yes, no, a wrapper. I mentioned like an investment wrapper. No, look, let's actually talk about two things: cryptocurrencies and gold. And actually, that's Stuart was mentioning how the plunge in cryptocurrencies encouraged people to rethink about gold again. And I was making a reference to that as well when I was talking about gold's role as a safe haven in a period of crisis. During 2021, when cryptocurrencies were kind of like rallying for most of it, not all of it, but most of it, many investors were basically saying that, again, like cryptocurrencies were the asset or the way in which investors were going to hedge, and that they were the actual, new safe haven and so on and so forth. We had been discussing for a while the differences between cryptocurrencies, themselves, just, Bitcoin and similar structures versus gold, like the fundamental differences, the practical differences. And it was not until 2022 with, again, another real life example, because there had been some in the past, but people forget fast. So another real life example where cryptocurrencies completely behaved in the opposite way that people thought they would, because they were not at all behaving like safe havens. They were behaving just like tech stocks. So while everything was falling, and in particular cryptocurrencies were just tying along. Now, I think that, the concept of the idea of cryptocurrencies in essence is a way to make transactions cheaper and to create some sort of safety through kind of like a distributed ledger, right? So that you don't have a concentration. That was, again, if you dial back the clock to 2009 to early 2010 when Bitcoin was kind of like first introduced. That was the initial concept, right? So the point is that it makes sense to try to reduce costs of transactions of different things. And of course, people are looking for something, that is safe. Now, what happens is that in 2003 and then 2004, when gold-backed ETFs were introduced, were a way to kind of like give access to physical gold to investors through a wrapper, right, through an investment vehicle that was kind of like more cost-effective. So again, if you think about tokens as means to access gold, it would be another type of wrapper that, of course, opens up a new set of demand. So it's important and is, relevant. Now, whether all tokens would be that way, I don't know. But I do think that there's definitely a ton to explore in terms of having different ways to access gold in a very cost-effective way. And one of them could be through a token. Now, in the end, if the token is backed by gold, then it will behave like gold, right? And therefore, again, prices are going to move, based on similar dynamics as they move today. It may be just like a broader investment or a broader demand base, which is really interesting and really appealing, right? So that's why I meant by saying that it's a wrapper, right? But it's an important wrapper that can be quite cost effective for some investors and make it attractive. But in the end, we do know that gold stands very much apart from Bitcoin and similar cryptocurrencies, and could be and is actually a very important way to mitigate risks, even for those investors who want to gain money through cryptocurrencies that are not backed by anything.
So we agree that Bitcoin and cryptocurrency, as we've known it, much like the internet bubble in the late 1900s and early 2000s, bursted, and out from that came an internet that we all use today. Are we going to have a universal currency potentially backed by that wrapper in gold that could work? And I'll ask both of you gentlemen here on this panel, Juan Carlos and James, for your opinion on that.
Again, not necessarily sure if it'll be a universal one, but I do think that it's important. And you make a point that, through cryptocurrencies as we know them today are going to evolve into something different, right? Because clearly, again, there's going to be regulation and many other things that change the initial way in which they were described. The more that they are used, again, that elicits more scrutiny, perhaps, and a better way to understand those things. Again, I do think that blockchain, the underlying technology behind cryptocurrencies and the link to tokens, can modernize certain aspects of the financial market, and many markets, including gold, can benefit from that.
James, how does that wrap into your calculus, the calculus of HSBC and blockchain and banking, and tied into gold?
Well, I would draw back a bit and say and make a couple of points. I mean, I can't speak for the bank's view on blockchains, but I do agree with Juan Carlos about tokenization and the ability to access gold in a different way and to use it. And that for sure, I think, is a big positive for the market and for the bullion market. And it shows the universality and the applications for gold, which have evolved over the centuries. But just touching on the crypto issue, which, gets more press, the volatility of cryptos blows the argument for its safe haven characteristics right out of the water. I mean, it just, you can't make that argument. And so in that sense, when cryptos compared to gold, the comparisons are fallacious and they don't hold water. And the other thing is that, ask yourself, what is the nature of something and why do you hold it? And one of the reasons that you want gold is because you can physically hold it. And I've never seen anybody hold a cryptocurrency. And you can have it, you can store it. It is no one else's debt. And so in that sense, I don't think that the cryptos are going to turn out to be the rival, to gold that had earlier been thought. The other thing too is that, they don't have the longevity, nothing has the longevity of gold actually. But as far as tokenization of the market goes, then I definitely think that's coming and there's opportunity there.
I think you just made the case for gold way up and down the chain, all the way up from the funds and banks such as yours and way down to the juniors. I think we've got nothing but good news ahead somehow. So invest in gold. Thank you very much, everybody. I'd like to thank Chris Mancini, James Steele, Juan Carlos Artigas, and Stuart MacGyver for joining me today.
Thank you.
Thank you.